Okay, let's unpack this. Imagine you're trying to trade a massive block of shares. We're talking hundreds of thousands, maybe billions.
Right.
You can't just, hit buy on a market order like you would for 100 shares.
Yeah.
Doing that, well, it would likely push the price way up against you if you're buying.
Or way down if you're selling, yeah.
Yeah.
Simply because there just isn't enough liquidity, enough people ready to trade at that exact best price instantly.
Exactly. And that costs you incur.
Yeah.
The difference between maybe the price you thought you'd get when you decided to trade and what you actually average out at.
That's it. That's what we call slippage. And look, minimizing slippage is absolutely critical. I mean, even small amounts, tiny bits of slippage, they can completely wipe out the profit potential of a strategy, especially in, high-frequency trading.
Right. And that brings us kind of to the core of this deep dive. We're looking at how machine learning, ML, is fundamentally changing how trading firms handle this exact problem.
Yeah, executing these big orders with minimal market impact, designing smarter, more adaptive algorithms.
But the story doesn't quite end there, does it? This intense focus on optimizing execution down at the microsecond level, it has these really fascinating implications for the bigger picture.
Uh-huh. Market efficiency.
Exactly. Market efficiency, this idea that all the relevant information gets baked into asset prices really, really quickly.
And these two concepts, they seem worlds apart sometimes, granular execution and broad market efficiency, but they're surprisingly intertwined. It's quite interesting.
So our mission today is to, well, deep dive into the sources you've shared. We want to explore the nuts and bolts of how these ML algorithms get trained on this incredibly detailed market data.
Yeah, the microstructure data.
Right, to make these split-second decisions. And then we kind of want to zoom out, understand how this technological arms race, if you like, is influencing the very nature of how markets actually function. Ready to jump in?
Let's do it.
All right, so let's start with that fundamental challenge again. You've got this giant order, way bigger than the market can just swallow at one price point right now. What's the sort of traditional way folks handle that without causing total chaos?
Well, the standard approach, it's pretty simple in concept, really. You just break that big order into lots of smaller pieces. People call them slices or child orders.
Lysis. Okay.
And you release those slices into the market over a set period of time. Could be minutes, could be hours, depends on the order. The whole job of the execution algorithm is basically scheduling. When do you trade? How large is each slice? To get the whole order done by the deadline while minimizing that pesky slippage we talked about.
So it really comes down to timing the release of these bits to navigate whatever liquidity is available.
Exactly, finding those pockets.
So what were the sort of early go-to strategies before ML really got its teeth into this?
The most basic benchmark, the one everyone compares against, is TWAP, time-weighted average price.
Probably.
It's really the simplest kind of risk-neutral approach. If you've got, say, a 60-minute window to trade, TWAP just says, okay, trade 1/60th of your total volume every single minute. It assumes absolutely nothing about where prices might go or when volume might spike.
Like a drip feed. Very
Yeah,
predictable.
exactly. Set it and forget it, almost. It's easy, but, often leaves a lot of potential slippage on the table if the market isn't behaving perfectly smoothly, which it rarely does.
Okay, so that's straightforward, predictable. But what if you do have some insight, particularly into, say, how trading volume usually plays out during the day, like the morning rush or the end-of-day close?
Right. That's where VWAP comes in. Volume-weighted average price. It's definitely an improvement because it leverages information about the market's expected volume profile.
Okay, so how does that work differently?
Instead of trading evenly over time like TWAP, you trade proportionately to how much volume you expect at different times. So if history tells you, 30% of the day's volume usually happens in the first couple of hours.
Then you aim to get 30% of your order done then.
Precisely. A VWAP strategy would try to execute 30% of your order in that initial period. And actually, VWAP can be shown, mathematically, to be optimal under certain assumptions, risk neutrality, permanent or market impact, if, and this is the key part, if you have a good prediction of that volume curve.
And predicting that volume curve, I'm guessing that's one of the first places where ML started to make a difference, even before the really complex stuff.
You got it, exactly. Even relatively simple ML techniques could build much more accurate, dynamic volume profiles than just looking at last week's average or something static. So right away, ML started providing better inputs for these existing algorithms, reducing slippage compared to a naive TWAP or a VWAP based on a bad forecast.
Great. Now, shifting gears to the cutting edge, these really sophisticated ML execution models. They need way, way more data than just historical prices or daily volume patterns, right? They need to see the market's, I don't know, nervous system in real time.
Oh, absolutely. They really do. To predict and react to what we call market microstructure, that's the really intricate dance of buyers and sellers interacting at the finest level, you need high-frequency data. Specifically, data from the limit order book, or LOB.
The LOBB.
This is basically the central database, the heart of modern electronic exchanges for things like stocks, futures, options. It's where all the waiting orders live.
So the LOB is essentially, it's like a live snapshot of all the traders who are sitting there waiting to buy or sell, and they're all sorted by price.
Precisely. It's organized by price time priority. So on the bid side, you've got the buy orders. They're stacked up from the highest price someone's willing to pay going down.
Highest bid first.
Right. And on the ask side, you've got the sell orders stacked from the lowest price someone's willing to accept going up.
Lowest ask first.
Exactly. And the very highest bid is called the best bid. The very lowest ask is the best ask. And that difference between them, that's the spread. The source material actually has a great visual for this. Exhibit 1, it kind of shows you these different price levels on both sides, and the depth, basically, how many shares are available at each of those price steps.
Okay. So if I come in and place a market buy order, I'm basically hitting that best ask, taking the lowest available sell price.
Yep.
And a market sell order hits the best bid, takes the highest buy price, they execute instantly, right? And they use up the liquidity sitting at those best prices.
Right. Those are what we call liquidity takers. They consume the available orders. Now, if you place a limit order, maybe a buy order that's below the current best bid, or a sell order above the current best ask, well, it won't execute right away.
It just sits there.
It goes onto the book and waits. You are effectively providing liquidity. You're offering to trade at a specific price, hoping someone else will come along eventually and take your offer, hit your price.
And the advantage there is maybe cost.
Yeah, potentially. Getting filled on a passive limit order like that can effectively earn you half the spread compared to crossing it with a market order. That's a powerful way to reduce execution costs. But there's always the risk. It just sits there and never gets filled. Uncertainty.
Got it. And the sources are really clear on this. A simple line chart of historical prices just isn't going to cut it for training these advanced ML models. You absolutely need this detailed LOB data.
Exactly right. A time series of just the mid price or the last traded price. It misses all that crucial context. What's the supply and demand waiting on the book right now? You need the LOB data, ideally showing the depth of volume across multiple price levels, not just the very best bid and ask.
And how does this data actually arrive? Is it like a constant stream?
Well, it can come in a couple of ways. The most detailed is market by order, or MBO. That's literally every single message. Every new order placed, every cancellation, every execution. It's the full fire hose view. Gives you perfect reconstruction.
Wow, that sounds like a lot of data.
It is. Or you can get snapshots. Pictures of the LOB state taken, say, every few milliseconds. Snapshots are less granular. You might miss some fleeting events between them, but they're often sufficient for model training and definitely easier to process.
Okay, so armed with this incredibly rich, high-frequency LOB data, what exactly are these sophisticated ML algorithms trying to predict? What helps them minimize that slippage?
Yeah, good question. They're trying to forecast variables that directly impact the cost and the risk of executing your trade in the very near future seconds, milliseconds ahead.
Like what specifically?
Well, forecasting the market spread itself. Obviously, a narrower spread means crossing it costs less, so knowing if it's likely to narrow or widen is useful. Predicting trading volume is key too, because if you expect a burst of high volume, you might be able to push through a larger slice of your order with less price impact.
Okay, spread, volume, anything else?
And return volatility, predicting how much the price is likely to jump around. That's really key for risk management. If high volatility is predicted, maybe you want to trade more aggressively, get your order done faster before things get too crazy, or maybe wait it out. Depends on your risk tolerance.
And the sources dive into some really specific signals derived from the LOB that seem particularly powerful for making these kinds of predictions.
Yes, these are fascinating. They're like reading the tea leaves of the market microstructure. One really important one is order flow imbalance, or OFI.
OFI.
This was kind of a aha signal people found hiding in plain sight. It's not just about how much volume is trading, like we discussed with VWAP. It's about the net flow of buy versus sell pressure that's actively entering the market right now.
So not the orders sitting there, but the new activity.
Exactly. OFI tracks things like new buy limit orders coming in, cancellations of existing sell orders, and market buy orders executing. It's the change in pressure. And if you see a surge in positive OFI, it tells you that buy-side pressure is rapidly building up. Research has shown this really strong, almost linear relationship between high OFI and the price moving up very shortly after.
Interesting. So OFI is about the dynamic flow. What about order book imbalance or OBI? That sounds related, but maybe different.
It is related, but simpler. OBI looks at the static picture of the book right now. It's typically calculated as the normalized difference between the volume available right at the best bid price and the volume right at the best ask price.
Just the top level.
Usually, yeah, the very front of the queue. It gives you a snapshot of the immediate supply-demand balance right there at the best prices. So an OBI close to 1 means there's way more shares wanting to buy at the best bid than sell at the best ask.
Suggesting upward pressure, like right now.
Exactly, immediate upward pressure. And an OBI close to -1 suggests the opposite, downward pressure. It's a quick, readily available measure of that immediate liquidity landscape at the tightest prices.
And there's also this term, microprice. How does that fit in? Does it use OBI?
It does, exactly. So the simple mid price is just the average of the best bid and best ask, right? Dead center.
Right.
But think about it. If there's vastly more volume stacked on the bid side, so a high OBI, doesn't it feel like the true center of the market's interest is actually pulled a bit lower, closer to that big bid?
Yeah, that makes intuitive sense.
So microprice does exactly that. It uses the OBI to calculate a weighted average of the bid and ask prices. It gives you a price that reflects the current supply-demand pressure right at the edge of the spread more accurately than the simple midpoint. And for an execution algorithm, that gives a more nuanced target or reference price when it's deciding where to place orders or maybe what the likely cost of crossing the spread right now is going to be.
Okay, so you can kind of engineer these clever features like OFI, OBI, microprice from the raw LOB data. How has the machine learning approach to actually using this data evolved over time?
Well, in the, let's say, early days, maybe 10, 15 years ago,
Yeah.
people would put a lot of effort into manually crafting these specific features. They'd calculate OFI, OBI, maybe volatility measures, things like that.
Handcrafted features.
Right. And then they'd feed those engineered features into simpler ML models, things like linear regression, support vector machines, maybe simple neural networks.
Okay.
But the modern trend, especially with the rise of deep learning, is increasingly to try and feed the raw LB data itself directly into much larger, much more complex neural networks. The idea is to let the network automatically learn which patterns and combinations of features are actually predictive without humans having to guess upfront.
So like showing the model the raw stream of orders and cancellations and just letting it figure out what signals matter most.
Precisely. Let the data speak through the model architecture. Now, the sources do mention an interesting one called the deep order flow imbalance model,
Yes.
which is kind of a middle ground. It does still engineer OFI features, but it calculates them from multiple levels deep in the order book, not just the top. And then it feeds those richer OFI signals into advanced networks like LSTM,
LSTMs.
long short-term memory networks. They're a type of recurrent neural network that's really good at processing sequences, remembering patterns over time, or sometimes combinations with other network types like MLPs, multi-layer perceptrons. And this model performs quite well, which shows that clever feature engineering can still be really powerful. It's not always about just throwing raw data at the biggest network.
But the sort of state-of-the-art example using raw data directly is this deep low model.
Yes, DeepLobe is a prime example of that raw data approach. It's quite clever. It basically treats the state of the limit order book over a short time window, almost like an image.
An image? How so?
Well, think of the LOB having price levels vertically and time horizontally for a short window. You get this grid of bids and asks and volumes. DeepLobe feeds this raw LB image into convolutional neural networks, or CNNs.
The kind used in image recognition.
Exactly. The same kind of networks that are great at finding patterns in photos, like edges or textures. DeepLobe CNN layers learn to find meaningful local patterns in the LOB data, maybe patterns across different price levels at one moment, or patterns developing over time at a specific level.
Okay.
And then these spatial and temporal patterns detected by the CNNs are often fed into LSTMs, those sequence processors we mentioned, to capture the overall dynamics and make predictions.
And what can DeepLobe predict really well with this approach?
It tends to excel at very short-term price prediction. We're talking milliseconds to seconds out, really fine-grained movements. And the sources also mention it can be extended. Instead of just predicting a single future price point, it can use techniques like quantile regression to predict a whole distribution of potential prices.
Ah, so it gives you a sense of the uncertainty. Like, it's likely to go up, but there's a 10% chance it tanks.
Exactly, which is super valuable for traders, right? It
Mhm.
gives you a much better handle on the risk involved in your next move.
Okay, predicting a single future point or even a distribution, that's useful. But for executing a large order over time, knowing the likely path the price might take seems like it would be even more valuable. Can ML models actually forecast paths like that?
Yes, absolutely. This is where we start borrowing some really powerful ideas from a different field. Natural language processing, NLP.
Like language translation.
Exactly like that. Think about sequence-to-sequence models. They're designed to take an input sequence, say, a sentence in English, and output a related sequence, the same sentence in French. We can adapt that same architecture.
Wow.
We feed it an input sequence of historical LOB states, maybe the last few seconds of data, and we train it to predict an output sequence of future price movements, maybe the next 5 or 10 seconds of expected returns. Essentially, forecasting a price path. And you can make these even better by adding what are called attention mechanisms. These were also developed for NLP. They help the model dynamically focus on the most relevant parts of the input history when it's predicting each specific step in the future path. It makes these multi-horizon forecasts using LOB data significantly more accurate.
Okay, this is getting seriously sophisticated. So we have all these powerful ML predictions flying around, spreads, volume, volatility, short-term prices, even entire future price paths, all squeezed out of this super granular LOB data. How do the actual execution algorithms put these insights to work in the real world?
Right, so an execution strategy, when you're dealing with these LOB markets, really boils down to making two key decisions for each little slice of your overall order.
Okay, what are they?
First, how much volume to trade and when to trade it over your allowed time window. That's the timing and sizing piece. Second, how exactly do you trade that slice? What price do you aim for? Do you place your order passively, hoping to get filled without crossing the spread? Or do you go aggressively cross the spread with a market order, or maybe a limit order priced to execute immediately? That's the placement decision.
And the fundamental trade-off there is certainty versus cost, isn't it?
Always. A market order gives you certainty of execution now, but it costs you at least half the spread, maybe more if you consume multiple levels. A passive limit order, placed deeper in the book, could save you that cost, maybe even earn you half the spread if you post at the best price and get filled.
But it might just sit there and not get filled at all. Risk.
Exactly. Uncertainty. So the ML forecasts help the algorithm navigate these trade-offs dynamically, slice by slice.
Can you give an example?
Sure. Let's say the volatility forecast predicts the market is about to get really choppy, really volatile. The algorithm might decide to trade more aggressively, front load more of the order to reduce the risk of prices moving wildly against it later.
Right.
Or the volume forecast might predict a big surge in liquidity in, say, 5 minutes. The algorithm could then plan to release a larger slice at that specific time, hoping to get better execution with less impact.
And the price path forecasts, how do they influence the placement?
They're crucial for that passive versus aggressive decision. Imagine you're buying, and the ML model strongly predicts the price is about to jump up significantly in the next few seconds.
You want to buy now before it jumps.
Right, so the algorithm might decide to cross the spread with a market order immediately. But if you're selling, and the model predicts that same jump, you might do the opposite. You might place a passive sell limit order a bit higher up, hoping the price rises and comes to you, giving you a better price.
Makes sense.
And the sources also mention probabilistic placement. Instead of a hard roll, the algorithm might just increase the probability of placing passive orders when the ML forecasts suggest conditions are favorable. This can also make the strategy less predictable to others trying to game it.
Okay, so using ML to predict key variables and then feeding those predictions into some kind of rule-based system or optimization framework to make the timing and placement decisions, that's one major approach. What's the other big ML paradigm people are using here?
That would be reinforcement learning, or RL. This is quite a different philosophy.
Okay.
Instead of training separate models to predict specific things like price or volume and then having a separate logic layer decide what to do, RL tries to learn the entire execution policy directly, end to end. The algorithm, which we call the agent, learns the optimal sequence of trading actions, how many shares, what price level, when to act, simply by interacting with the market environment and learning from the outcomes.
Interacting, how does that work? Does it place real trades?
Not usually for training, no. That would be way too risky and expensive. The interaction happens in a simulation. The agent observes the current market state. This observation could be raw LOB data, or maybe those engineered features like OFI and OBI we talked about, or it could even be the predictions from other ML models.
Okay, it sees the state. Then what?
Based on that observation, its current policy tells it to take a specific trading action. Place a limit order here, cancel one there, send a market order for this many shares, maybe do nothing.
And then?
That action has a consequence in the simulation. It results in some execution cost slippage, and it might change the market state slightly. The algorithm then receives a reward signal, which is usually inversely related to the cost incurred. So lower slippage means higher reward.
And it wants to maximize the total reward over the whole trade.
Exactly. By trying out different actions in different states and seeing the rewards it gets in the new states it ends up in, the RL agent gradually learns a policy, a mapping from observations to actions that maximizes its cumulative reward, which means minimizing total slippage.
That sounds incredibly powerful. Like it's learning the trading intuition itself directly from experience.
It can be, yeah. The problem is often framed mathematically as a partially observable Markov decision process, or POMDP. That's just a standard way to model sequential decision-making, where the agent doesn't necessarily see the full, complete state of the world, which definitely fits financial markets. You never know everything other traders are thinking or planning.
But you mentioned training this in simulation. Training something like that directly in the live market seems, well, insane. One bad learning step could cost a fortune.
Oh, absolutely. That is the single biggest hurdle for using RL in trade execution. You need an incredibly realistic, high-fidelity simulation environment to train the agent effectively. If the simulation isn't realistic, the policy it learns might work great in the simulator but fail miserably or even disastrously in the real market.
Why are simple simulations not good enough? What do they miss?
Well, simple simulations using just historical price series, like just a line chart, they're useless for this. They have no concept of an order book, so they can't tell you if your hypothetical limit order would have actually gotten filled. And crucially, they don't account for market impact, the fact that your trades actually influence the price.
Right. Your own buying pushes prices up.
Exactly. So you need more sophisticated simulation approaches.
Like what?
Well, improvements include using stochastic price impact models. These try to capture mathematically the probabilistic way your trades affect future prices, both temporarily and permanently. That's better. An even better approach often is market replay using that super detailed MBO data we discussed earlier.
How does replay work?
You essentially take the historical stream of every single real order message. Then you inject your RL agent's hypothetical orders into that stream at the correct time. The simulator can then determine precisely how your orders would have interacted with the actual LOB state at that microsecond, how they would have matched against real orders, and how they would have cleared volume from the book. It's much closer to reality for limit order fills.
Okay, that sounds pretty good. But even market replay. You'd mentioned earlier this thing called the counterfactual problem. What's that about?
Yes, this is really the frontier, the really tricky part. Historical data, even perfect MBO replay, only shows what did happen in the past. It doesn't show what would have happened differently if your large order, which wasn't actually there historically, had been present and executing.
How could it be different?
Well, maybe your buy order filled and took liquidity that historically went to someone else. Maybe that prevented their order from filling, which then caused them to change their subsequent trading strategy later on. The historical data can't capture those potential reactions from other market participants to your actions. It's the what-if scenario.
So how on earth do you simulate that? How other people might react?
That's where agent-based modeling, or ABM, comes in. This is a very advanced simulation technique. Instead of just replaying history, you try to create a virtual market populated by many artificial traders or agents. Each agent has its own simplified goals, information, and trading strategies. Some might be noise traders, some might be simple market makers, some might be trying to execute VWAP.
Like a sensitive of the stock market?
Kinda, yeah. A complex ecosystem. And then you drop your RL agent into this simulated market full of interacting agents. Now, when your agent trades, the other simulated agents can react according to their own programmed rules. This allows you to start exploring those counterfactuals and train an RL policy that's potentially robust to the reactions of others. But building and calibrating these ABMs is extremely complex and computationally intensive. It's very much ongoing research.
Wow. Okay, so we've really journeyed deep into the microscopic world of the LOB. Through these ML models predicting fleeting signals, algorithms, slicing trades, placing orders dynamically, even learning entire policies with RL in these complex simulations,
Hmm.
all laser-focused on minimizing that very practical cost of slippage.
That's right.
Now, let's do that zoom out we promised. Let's connect this intense, high-frequency algorithmic focus to the broader, almost philosophical idea of market efficiency.
Right, market efficiency. It's one of those core concepts in finance. And at its heart, it's actually a pretty simple idea. It just means that relevant information travels fast and gets reflected in asset prices very quickly.
So in a perfectly efficient market, there are no easy profits lying around.
Pretty much. Any opportunity to make a guaranteed, risk-free profit from some kind of price discrepancy, what economists call an arbitrage opportunity, would be instantly spotted and exploited by sharp-eyed participants. And the very act of them exploiting it would cause the prices to snap back into line almost immediately, eliminating the opportunity before anyone else could jump on it.
And things like, say, companies having to disclose earnings publicly or rules against trading on insider information, those are designed to help make markets more efficient.
Precisely. They aim to level the playing field, make sure information gets out there broadly, or prevent people from using non-public info for an unfair advantage. Both promote faster, fairer price discovery.
How do academics or researchers actually try to measure how efficient a market is in practice?
Well, one common way is to look at event studies. How quickly does a stock's price fully adjust after a significant piece of public news is released? Could be an earnings report, maybe a merger announcement, or, as one of the sources mentions, even something like drilling results for a mining company. In a highly efficient market, that price reaction should be incredibly fast, almost instantaneous once the news hits the wires.
And presumably not all markets are equally efficient. A big stock exchange versus, I don't know,
Yeah.
a market for rare art.
Definitely not. There's a spectrum. Highly transparent, high-volume markets, like the major stock exchanges in developed countries like the US or UK, are generally considered to be very, very efficient. On the other end, you might have less liquid, more opaque markets, maybe certain types of bonds, or markets in smaller, less developed economies where information might travel more slowly and prices might take longer to adjust. They're considered less efficient.
This whole idea is famously wrapped up in the efficient market hypothesis, the EMH, often linked with the economist Eugene Fama. Can you break down the different versions of the EMH? I know there are a few.
Sure. Fama laid out this influential hypothesis, and it's usually talked about in three forms, each one getting progressively stricter about what information is supposedly reflected in prices.
Okay, form one.
The weakest form, the weak form EMH, basically says that you can't consistently make excess profits just by looking at past prices and trading volumes. All that historical data is already baked into the current price. Essentially, it implies that technical analysis looking for patterns in charts is pretty much useless for consistently beating the market.
Okay, so history doesn't help predict the future. What's next?
The semi-strong form. This goes further. It says that prices instantly reflect all publicly available information. That includes not just past prices, but also company fundamentals, economic news, analyst reports, everything that's out there in the public domain.
And the implication of that.
If the semi-strong form holds, then neither technical analysis nor fundamental analysis based on public information can consistently give you an edge, because any value you think you found is supposedly already reflected in the current price.
Wow. Okay, and the final, strongest form.
The strong form EMH is the most extreme. It posits that prices reflect all relevant information, period. That includes public information, A&D, private, or insider information.
So even if you had illegal inside information, you still couldn't consistently beat the market.
That's the claim of the strong form. Yes, it's a very high bar, and most people think it doesn't fully hold in reality, otherwise there'd be no incentive for regulators to prosecute insider trading. But it's the theoretical endpoint.
And which version of the EMH people believe holds true has huge implications for how you should invest, right?
Absolutely massive implications. If you only believe the weak form holds, then maybe you think skilled fundamental analysts can still find undervalued companies by digging into public data better than others. But if you believe the semi-strong form largely holds,
then active fund managers trying to pick stocks based on public info are mostly wasting their time and your fees.
that's the logical conclusion, yes. It suggests that trying to beat the market consistently is incredibly difficult, and maybe you're better off just buying a low-cost index fund that tracks the whole market. It makes passive investing look very appealing. And if the strong form held, well, any kind of active trading would seem like pure luck or gambling.
And the academic evidence. Books like A Random Walk Down Wall Street always come up here. What does the research generally find?
Yeah, decades of academic research. It tends to provide a lot of support for some version of the EMH, especially in those large, liquid, transparent markets we talked about. The evidence strongly suggests that after accounting for trading costs and management fees, the vast majority of active fund managers do not consistently outperform their market benchmarks over the long run.
So the data leans towards markets being pretty efficient, maybe somewhere close to that semi-strong form.
That seems to be the general consensus for major markets, yes. It's hard to find persistent, exploitable edges using only public information.
Which leads us to this really interesting almost paradox, right? If markets are that efficient and active managers generally can't beat them consistently, why do these active managers, especially like sophisticated hedge funds with complex strategies and high fees, even exist? They seem kind of redundant or just expensive overhead.
That is a very common and totally valid question. If the game is that hard to win, why are so many smart people playing it and charging so much? And the source material offers this really compelling alternative perspective, a shift in how to think about it.
Okay, what's the shift?
Maybe these active managers, particularly the really sophisticated ones using cutting-edge technology like the ML execution algos we've been discussing,
Yeah.
maybe they aren't just trying to profit from market inefficiencies. Maybe they are the very agents who create and maintain that market efficiency in the first place.
How does that work? They're like the efficiency engine.
Exactly. Think about it. They are constantly fiercely competing with each other. They're using incredible resources, data, technology, brain power to instantly process any new information, identify even the tiniest, most fleeting price discrepancies or predictive signals, and act on them with high-speed algorithms.
Like the OFI signals or the deep low predictions.
Precisely. And by doing that, by collectively pouncing on any potential inefficiency the moment it appears, they ensure that information gets incorporated into prices incredibly rapidly. Their relentless competitive pursuit of profit is the mechanism that drives the market towards efficiency. It closes down those arbitrage windows almost instantly.
So their fees, you could almost see them as the cost the market pays for this service, the price of having information reflected in prices almost immediately.
That's the argument. From a system-wide perspective, their activity, even if individually they struggle to consistently beat the average after costs, might be essential for making the market work as efficiently as it does for everyone else.
That is a fascinating reframe. They're not just playing in an efficient market. Their collective actions are constantly making it efficient.
Exactly. It turns the paradox on its head.
Okay, so let's try and tie these two big threads together now. We've explored how these incredibly sophisticated ML execution algorithms are diving deep into the market's microstructure, the LOB, using signals like OFI, OBI, microprice, generated from high-frequency data
Right. Predicting fleeting dynamics.
to minimize slippage on timescales measured in milliseconds or seconds.
Ah,
And we've also talked about market efficiency, this idea that information gets reflected in prices super fast, potentially driven by the actions of these very same sophisticated players.
yeah, the connection seems pretty direct when you lay it out like that. These ML algorithms are operating right at the bleeding edge. They're trying to capture tiny advantages, maybe fractions of a basis point, by reacting to subtle shifts in supply and demand pressure far, far faster than any human trader ever could.
So considering how widespread and powerful these algorithms are becoming,
Mhm.
are they just operating within an already efficient market, sort of leveraging its existing dynamics? Or is their very existence in operation actively pushing markets to become even more efficient than they were before?
I think the evidence and the logic point strongly towards the latter. They are active drivers of efficiency. By instantly identifying and acting on these tiny fleeting signals embedded deep in the order flow and the book structure, signals that might have been completely invisible or unexploitable just a decade ago, these algorithms are ensuring that even that micro-level information gets reflected in transaction prices almost immediately.
So the competition to build better ML execution tools.
That competition is inherently a race to find and exploit and therefore simultaneously collapse these micro inefficiencies. It's constantly pushing the market towards higher and higher levels of efficiency, particularly at that very fine-grained microstructure level.
It feels like the very definition of what quickly reflected information means is being constantly redefined, compressed by the speed and intelligence of these algorithms.
I think that's a great way to put it. They aren't just reacting to the market state. They're actively accelerating its evolution, making it faster, tighter.
Yeah. The pursuit of minimizing that tiny fraction of execution cost using the most advanced ML,
Yeah.
it seems fundamentally tangled up with this relentless drive towards more efficient price discovery in modern electronic markets.
Absolutely. The two are deeply intertwined.
So here's a final thought then, something to leave with you, the listener. Think about the implications of this ongoing technological race. As these ML execution algorithms get ever more sophisticated models that can forecast entire price paths, RL agents learning optimal policies in hyper-realistic simulations. How is this fundamentally changing the structure, the dynamic, the very feel of financial markets? Are these algorithms just becoming incredibly skilled players in a game that's getting faster and more efficient? Or are they the primary force making the game faster, tighter, and perhaps in some subtle but important ways fundamentally different from the markets of even the recent past? Is this relentless pursuit of tiny execution advantages actually reshaping the entire playing field?
It's a really compelling feedback loop to consider, isn't it? The technology and the market, they're just evolving hand in hand, driving each other forward.
Definitely a lot to think about. We've covered a lot of ground today, from the gritty details of the limit order book and machine learning predictions.
All the way up to the big, high-level concepts of market efficiency and the EMH.
From microstructure friction to, well, almost macroeconomic theory.
Mhm.
It's clear that ML isn't just some fancy tool for slightly better trading anymore.
No, it's really becoming a fundamental participant, shaping the ongoing evolution of how financial markets actually function.
Well, thanks for taking this deep dive with us into this really fascinating intersection of machine learning, trade execution, and market efficiency.
My pleasure. Always interesting to connect the dots.
Until next time.